Welcome back. Welcome back to the Real Estate Reserve Podcast. Hope everybody's well. Hopefully 2025, we're about 13 days into it, is going great for everybody. I'm Jason Balin from Hard Money Bankers. Ian Horowitz, co-host and Equity Warehouse co-owner. Looking forward to a great episode today, Ian. It's just the two of us. We have no guests today, but definitely a topic that the two of us chat about regularly. So we wanted to make both of our opinions vocal related to this topic. I know we have similar views, but they might differ. And I think it's an important topic, especially right now, as there's an argument that real estate's at the top. Although I did hear somebody say that they believe that there's some asset classes are at the bottom, but it's definitely something to discuss.
Yeah, it's funny, and I guess we'll hop right into it. You say like, "Hey, real estate's at the top," and I know that's not necessarily your move to why you should sell, but I'll tell you what. In 24, we had one of the biggest learning lessons about selling real estate and capitalizing real estate, and it actually didn't come from anything that was distressed. It came from something that was performing. And, I think it was a learning lesson to say, take your chips off the table as much as you can. And the more you can do that, the better you are. And I think that's for any investment, right? Like you do a lot of hard money loans, you're de-risking every time someone makes a payment because you're getting principal back, even though the government might view it as an interest payment, right? But for you, every time you're getting a payment back, you're de-risking your investment. Every time we make a distribution, people are de-risking their investment because they got their principal back. And when we had the opportunity to sell an apartment building and it came up and it was like, hey, you're going to get 10 years of cash flow. It's like, well, I don't know that we're at the top. I don't know that we're at the bottom. I don't know where we are in this cycle. But what I do know is I have the ability to sell this property, get 10 years of cash flow for me and my partners in one big swoop. We have like limited tax implications because we have a ton of depreciation losses from our other assets that allows us to sell this almost in a tax-free position and keep it moving. I was like, oh my God, dude, like we need to do this. And never before, ever. I mean, this property consistently produced returns. And that was like the eye-opening experience because we've been pretty good collectors of real estate is a good way to say it, right? Like we have a lot of assets. A lot of them perform. Some of them, are having issues, and we're navigating that right now. But people would say, well, cut your losses with your bad ones. It's not always cut your losses with the bad ones. Sometimes it's cut your losses with the good ones, or get your winnings today is a better way to say it, and get that and be able to reinvest that capital into a new deal.
Yeah, and it's not necessarily just you said getting your investors paid off and getting your cash back out. A lot of it's also just locked equity that you've got tied up. So we're going to go into this topic today. We've definitely got some insights from experience, on this, and it's a good topic. So when you said, let's describe to some of the audience, and the viewers and watchers related to 10 times profit, 10x profits. So really, what Ian's meaning on that is. He's at a point right now where how much were you making cash flow a month? Let's just use that.
$2,500 a month.
Okay. So $2,500 a month, right? So, and that's net cash flow, right? Times 12 is $30,000 a year, right? So he's making $30,000 a year. He was saying, 10x, it takes, which is $300,000, where in essence that it would take him 10 years with everything performing perfectly, no additional capital improvements, no lost rents, no vacancies, no anything, anything else to make $300,000. Right. So, yeah. And in his opinion, in this particular case, it's like, okay, can I make $30,000 this year on this thing? Pretty passive, right? It's already performing. Or should I sell this thing and make $300,000, 10x? And I guess the question is what number makes sense? Like, how many years of profits make sense to you for that to work?
Yeah. Okay. So let's use the same case. And some of this is to kind of make it a little more complex for some of our viewers that operate at a higher level. But even for simple people, it's real simple. Like, well, it's not real simple, I guess, is the problem is, before we made that sale, I would always say 10 years is kind of my cutoff, because then after that, like, what's the point? What's another 5 years? But looking back on it, it's like, dude, you're one fire, you're one issue, you're one problem tenant away from wiping out your cash flow on every single property versus being able to pick that up and reinvest it. So we own those properties for 4 years, right? Well, in year one, if somebody would have offered us 5 years of cash flow minus the ego hit, we probably should have taken it, right? Maybe even 3 years, because your rate of return is going to be insanely high. Now, we owned it for a period of time and we knew that there was predictable cash flows. I would say it's somewhere between the 5 and 10-year number. The 10-year number is like really cool, especially against trapped equity, right? Your cash flow to trapped equity, like that's a massive return. I'm not exactly sure how to calculate this yet. But we got a lot of money in exchange for our trapped equity. At 5 years at 150 grand, I'd be like, yeah, I don't know. I probably still would have done it based on where we were in the time horizon. I think it's somewhere between 5 and 10 years. And I know it's a vague answer, but I think it's a case-by-case basis based on what your property is. And I got an example, but I want to hear your opinion on it first.
Well, so there's another thing to take into consideration related to value add. Most real estate investors, not that it's not a good investment to buy a income producing property that you're going to continue to stabilize and potentially has, there's still meat on the bone that you could do a little bit of value add to increase it. But a lot of the projects in general are value add deals to begin with, right? So like, think about how's that's set up. And I'm just going to use very simple numbers. You buy a property for, let's just say it's a buy, fix, and hold on a single family rental property. Well, it doesn't have to be a big commercial building or apartment building. You buy it for $100,000. You put some 20, 30 grand into it, and then it's worth $200,000, right? And instead of selling it, you hold it as a rental, right? So that's kind of one side, and you've improving the property and increasing the property value because you did that value add. Well, that value add's over. So like day 1 through, call it 4 months, you went from, your cost being 100 plus, call it 20 or 30 in work plus some overhead. Let's just call it, your cost was 140 and it's worth 200. You made $60,000 in profit. Well, that's not going to happen, in year 2 or year 3 or year 4. The value add component is completed, right? So that part's done. Now, yes, there are deals where you can potentially have second and third value add components, right? Like you've got some storage properties that you went in and you fully stabilized, you made some improvements, and then after that you subdivided them and added some additional storage facilities and stuff like that. But most of the time it might not end up being that. So what I think happens is, as these real estate investors are going in and they're stabilizing these properties and they're increasing in value, either because of the market conditions or because the value add component, there's a lot of equity in there. And then you make that decision. Do you want to keep this as a long-term hold, or do you want to sell this and move to the next play? The difference between, I think, some of the bigger projects, the commercial stuff, compared to the smaller stuff like the residential stuff, is kind of timelines. You got out of it took you a few years to stabilize that and get that value add in there. So you're also able, to pay long-term capital gains on that thing, right? A lot of fix and flippers in real estate, it's a little bit different.
And I think on the residential space, like when you're looking at $300 to $500 a month cash flow, people look at it and say, oh, $3,600 a year in cash flow. If everything goes right and I sell it and I get 20 grand, most people are like, oh, well, it's not really worth it. But dude, like, it is, right? You're de-risking. The goal is always to trade up. I just ran into a friend of ours who's got 300-400 houses in Baltimore, and I was talking to him. He's like, "Oh, what are you up to?" I said, "Well, we've been coming through our portfolio and selling assets off as tenants move, and let's stay in the single family space because I do have some commercial examples as well." He's like, "Well, why are you selling them off?" I said, "Dude, like we've owned them for a period of time." We've paid down principal, markets increased, we've made cash flow, but instead of getting that $20,000 hit, we're starting to see $60,000-$70,000 hits or bigger. And it's like, dude, for $300 a month to get back 60 grand is a no-brainer. And $300 a month is if everything has gone exactly right. And I've earned a lot of gray hair, no hair on top of my head, because we navigate and fight through a lot of these problems. But what we're starting to do is, if we sell that and then turn around and go buy like a James Way, which we recently purchased with some friends and family, is, dude, we bought that. We took it, we placed it right into our property manager's hands, our leasing broker's hands. And now what we get is a leasing report, and we get a property management report. And we just get to concentrate on what we like doing best. And that's construction. And I think that's the business plan going forward. And as we continue to go down that business plan, it's like, you know what, this makes more and more sense to remove the assets that got us started. And, we've talked about this a lot before, what it took to go from 0 to 5 million and 5 to 10 million are two completely different paths. And if we want to level up, part of leveling up is cutting our ties with some assets that they're not necessarily dead weight, but they don't serve us the same way that they did when we first started. When we first started, we needed the 100 houses to be able to go to the banks and say, look what we've done. We were real scrappy and we built this 100 house portfolio. They're like, oh shit, like you guys are legit. Now we have a balance sheet of nice commercial assets, and it's like, and cash in the bank to say, well, I don't care if I have those 100 assets. I got all these other things working, and I can show you that we're legit, and we have a track record now to continue down the path of continuing to execute in real estate as a whole. So I think there's monetary sides to it. I think there's where you're at in your business parts of it, and there's everything in between. And look, what you bought day one doesn't need to mean you owned it all the way to the end. We always said those things because it was like faucets. But you know what? Sometimes you got to change the faucet, right? You got to change the water lines that go to the faucet. You got to update your sink, whatever it is. And that's what we're working on. We're updating what worked for us and the faucets that produced us income. And we're making it better and better and better every time we sell something and buy something new.
Yeah, and here's the thing. It also is very dependent on the situation. We've been all fortunate that the real estate market has increased tremendously. So doesn't always happen like that, right? Like, it's not in every market that you're going to buy a property for 100 grand, put going back to this example, $30,000, $40,000 into it, and it being worth 200 if you decide to sell it or hold it as a rental. It's just not. Like, that's, there was a big value add. It's not only the value add, there's also the property appreciation. And I think that's when, folks, it's tough. Here's another example of that. Let's say you bought that same property for $140,000 and it needed $40,000 worth of work, and you're all in it at 180, call it. And it was worth 200. Would that be a bad investment? Maybe, maybe not. Depends on what it cash flows for. But let's say, you can get, good debt on it, or you buy it in cash and it cash flows because rents are great. That's still a good opportunity. It's a good investment. You might not want to sell that asset then. It doesn't make sense to sell that asset then. You don't have any locked equity or very little locked equity into that deal.
Yeah, so I got a similar example, and it's a property that you invested in. We were able to buy it, stabilize it, and then we got a real nice refinance, and we all took proceeds from it, right? From the refinance. It was a real nice payday, and we moved it along. But today that property is now sitting there, and we levered up on some debt. Rents have retracted a little bit. Leasing velocities retracted a little bit. And the thing kind of just mulls around, right? Because our debt, we took out a big swath of cash in exchange to own this thing and say, okay, well, long-term, it'll be resolved. But now I'm sitting there going, we don't get paid on it. We got some investors in there. They don't really get paid on it. Like, what's the point of owning this? And I mean, dude, we can clear, if the broker's correct, a couple $100,000 for us and the investors. Well, why wouldn't we sell that? Yeah, the property stabilized, it's doing its thing, but why sit here and wait around for the maybe day, right? And so I'm getting ready to sign the listing agreement and put that one out. I mean, dude, it's a no-brainer. And here's the thing. The investors will be like, oh, you know what? We did own that for a period of time, and I got another payday off of it. Great. Like, this is a no-brainer. And I think a lot of people get caught up to say, oh, I refinanced it. And I do this a lot. We refinanced it so our return's infinite. But, dude, the return on your time and brain damage to keep the thing afloat, necessarily isn't infinite, right? And yeah, there might be a bigger payday. You know, if you stay in the market long enough, and Dan and I talk about this, like our single family houses perform the best because we've owned them the longest. We've worked all the kinks out of them.
That's
And
right.
sure, some of our commercial assets will be better long term because our debt at that time will be lower. And even with rate resets, it'll still be lower. And we'll be able to get better returns. But like, why wait for that day so far down the line versus saying, yo, I get a couple $100,000. It could be 10 grand, whatever. It doesn't matter. You cashed out, you de-risked your portfolio. You know, again, you're one fire, one hurricane, one natural disaster away from having a headache on your hands. Sell it, keep it moving.
Yeah. So, and we should preface that this is for active real estate investors that aren't just like cashing out life. This is somebody who's going to reinvest these proceeds into the next better asset. Either an asset that has the ability to value add, appreciate, maybe it's more passive than the current asset. Maybe it doesn't matter, because that's what this is about. Is cool. I'm trading this so I can get into something better. And, you know, related to what I believe, how many times profit you would need to sell or trade is about 6. That's kind of give or take. And mine's on the low end because I want to keep things moving. I also come from like the world of in and out investments, not buy and hold investments, where, you know, I do short-term loans and it's like, cool, let's get paid off. There's lots of loans that like, it would be great if they stayed on my books forever. But at the same time, I don't have a problem that they pay off quick. I'll recycle it into the next deal and the next deal and the next deal. So, but that's kind of
6 years.
Where my head, yeah, maybe 6 years. I mean, it assuming there's no more value add. So there's a lot of exceptions to this rule, and we talked about this. That's
Right.
assuming that there's no value add, major value add. That's assuming that you're earlier on in the amortization cycle and not later on in your amortization cycle for your debt, right? Because if it's your last 6 years, like all that money is going right back to you anyways, because just going back to pay principal. But a lot of it has to do with where the market is now, and and nobody can judge where the market is headed or going. I mean, I know you try to, but that's challenging. But like, you've seen a good run, right? Like, there's a lot of assets that you have that I've been involved with as well, maybe, that have like doubled in value. A lot of it was market driven. Like, it's not going to double in value again. Like, over a long enough period of time, will it? Yeah, it will. But like, could you pull that cash out and put it into a new value add that you could double in value? And like, someone said, well, hey, would you ever sell your hard money lending company? Yeah, I mean, I would, at the right numbers that would spit me out the same returns that I'm currently making at the moment. You know, typically we lend out at like 13%, right? So, give or take. If I could, in essence, liquidate my ownership interests, I would get capital, and I can deploy that capital at something. It doesn't have to be notes. It could be notes at 13%. It could be rental properties. It could be whatever. And in essence, I could passively, two sides of this. I could take that capital and I could deploy that, and I could passively get the same rate of return as the money I'm making from the company every year. That's an option. Plus, I'd have the liquidity, because right now, you know, if you have business interests, it's trapped equity, right? It's an ownership interest and there's value to, but it's still trapped. If I could turn active income to passive income and make the exact same amount of money, I would do that. I think that's important, right? Or if I could take active equity and that's capped out and turn that into, a smaller basis equity that we could value add again, I would do that as well.
Yeah. I think that makes sense.
After this, let's jump into another live deal that both of us just got paid off on, because I want to talk about calculated returns that we got from that.
Yeah, and I think this is a really hard subject to do without like a whiteboard, because like we could sit here and debate this all day. In the end, I think people need to look at their portfolio and say, hey, I got that one house that performs well, it produces me cash flow, but is there an opportunity to exit? I saw a buddy of mine, he was talking about a subject to deal he did. He had it as an Airbnb. He felt as though the Airbnb market was starting to slide in the wrong way. Maybe he lost interest. Who really knows what's happening? but you got into the house for 500 grand with a $45,000 down payment, and he's going to list it for 750. And he's like, "Hey man, that's my exit. I got to go. It's a no-brainer." So let's talk about, and I'll let you
real quick on that, because I agree. And I want to dive into this as well. Is, again, to preface, this is being an active investor and also having opportunities. If you don't have opportunities to do it, it's not going to work. Like, let's say you had like $50 million in equity on a property. I'm just saying hypothetically, and you got $50 million cash today. Like, you're an active investor. It'd probably take you some time, but you could figure out a way to deploy that capital. But a lot of people can't. And if you can't deploy that capital, then it's a little bit more challenging. And I think, but like, if someone's actively buying rental properties and buildings, and they're like, well, I don't want to sell them. Why? It's like, well, there's a point where you have so much trapped equity or locked equity that you can start buying more and more. And yes, they might be at a higher basis, but they still potentially continue to make sense by doing so. But like, again, I've already said this several times. Like, this is assuming that you're an active investor and you're not just disappearing.
Yeah, I forgot we talked about that the other day, and I was like, I think I remember it coming up, and I was like, dude, you know what? Well, the reason why these guys don't sell and they want these legacy assets is because they get lazy and they're not in the market every day, right? Like, we're in the market every day. I was talking to you about it. I remember this now. I was like, dude, I can find a deal tomorrow. We sell a deal and we get back money. Like, we're going to find another deal to go do. That's a no-brainer.
Yeah. And here's another really good example that I think everyone can kind of test their portfolio on. So let's say you have a building. Let's just use very simple numbers. Let's say, you have $1 million building and it spits out $30,000 a year in net cash flow. It could be free and clear, or $1 million in equity, I should say. You have $1 million in equity. You could get $1 million and it's spitting out $30,000 a year. And it's like, I don't want to sell this building, blah, blah, blah. I've had it. There's no debt on it. And it doesn't matter if there's debt or debt, if there's no debt or there is debt, because we're basing this off of whatever your net return is. And you're making $30,000 a year, right? In essence, you're making a 3% return on that. And it's like, well, if I sell the property, I like that $30,000 in income. I live off that income, or I use this income, or I pay this for it, or whatever it is. But it's like, bro, you're getting a 3% return. And you have $1 million that is tied up. And you also have the risks of, hey, there could be a capital improvement. I mean, the issues that we had with rental properties, I know you have that you can observe with rental properties, is every major tenant turnover, 5, 6, 7 year turnover, you have to re-renovate these darn things, and you have high capital improvement costs. And we accounted for that because our rental portfolio we never used as income, right? So everything just recycled into the business. We weren't relying on it. And we also bought them at the right times, right? Like, we were buying properties in Baltimore in 2012, 13, and 14 for $40,000. And when we sold them in the 200, for $200-something thousand years later, like, the market helped us. That being said, like, yeah, the timing worked out, but like, what was the point of us keeping them? They're not going to go from like 200,000 to 400,000. I mean, maybe they will, but like, we took our chips off the table and we got into better assets that were kind of on the lower cycle, or the lower end of that asset class, that had that much more room to appreciate. But just check yourself, because you have that $1 million in equity, take that equity and invest in something completely passive and completely risk-free that you can. So what's the point? You're tying up that capital and it's not going to work. So anyways, you want to add anything on that, or you want to talk about the storage deal?
So I'm trying to type up the storage deal, see if I can share this correctly, and do it in real time. But go ahead and start talking about it, because I think maybe this will wrap people's heads around.
Okay.
I guess we should have done a better job of laying it out.
Do you think our return on the storage deal was a good return?
Let me say this. Initially, when I got back, like, our quote unquote equity pop and our cash that we earned out, I was like, yeah. All right, whatever. We both netted like 30 grand plus or minus. And I was like, it doesn't seem like a lot, right? But we also didn't have a lot of effort. We were pretty passive. We did the initial loan through one of our investors that we both know, and we were able to push that through. So in the end, it was like, once you put it on paper, I was like, that was a good return. in real time, the way the whole thing played out, I was like, well, that's stupid. Like, why?
Well, because it took 3 years. It took 3 years to get 30,000. So
no cash flow distributions, kind of what I'm going through with the other property that I described. I'm like, my investors own this property and they're just sitting here and dying. And unless they need the tax benefits of it, there's no point in owning this, right?
I think a big part of this discussion is that the rate of return annualized decreases the longer this thing's out for. And that's where 100%. It was. If this thing executed year one, and I'm not saying we expected it to execute in year one. And this, we can talk a little bit about your St. James execution as well as, hey, if execution, like if this can happen quickly, investor returns are going to skyrocket. And if it happens in 3 years, 4 years, or 5 years, great. That's a decent return too, but they're diminishing. When that happens. So I'll just do a quick backstory. One of Ian's, kind of mutual buddy reached out. He had a storage facility that he wanted to partner with. We structured it as a loan, as in essence, it was a 10% interest rate loan because there was equity to it, right? And we put a capital investor in at a 10% return. One of our capital investors. I actually had a small piece of that as well, so I got part of the 10% return. But take that out. Let's just assume it was a full-on capital investor getting a 10% return. No one made money. I didn't make any money on it. So my company, Hard Money Bankers, didn't make money. Ian's company, didn't make money on it at all, right? We just put a capital investor. They got the 10% passive return for being involved, and the split was cool. We'll each get 15%. So my company would get 15%. Ian's company would get. Was it 15%? 10 or 15?
Yeah,
15. So we got a 30% share. Typically, if we do a partnership, it would be higher. It'd be 50-50, maybe even more. But the operator and his friend that were involved, they actually put 30% of their own capital into the deal, right? So we only put up 200 and they brought 80 in or something like that, right? So we did a loan. 10% loan, and then Ian and I each got 15, or Ian's company, my company, each got 15%. So do you want me to talk about how the numbers mapped out years later? I mean, it took exactly 3 years, so it was easy to calculate because it was like almost 3 years on the day.
Okay, so like 3 years to the day, but let's just give you guys a quick overview. It was a storage facility. They came in, they stabilized it. It had its ups, it's had its downs. I think we made one distribution very early on for maybe like $500 or $700. And then after that, it was always like, hey, we got to save money for taxes. The partnership never really wanted to refinance and expand on the land that was available there to expand on. And it was like, okay, well, guys, what are we doing? And finally, the guy, again, kind of to my similar situation, the guy who was operating it, doing the daily, he had basically an equal share as what Jason and I did combined, our companies. And he was like, dude, you know what? Screw this. I got to start divesting some of my stuff because I want to concentrate on bigger stuff on my own. I said, dude, sell it. So probably about after, I'd say, a solid 18 months of trying to get this thing sold, he finally got it sold and it closed just the other day. And Jason can give you guys a rundown on the numbers. We were fine owning it. I mean, they were making payments. It was clean, but we didn't really make a realized gain until this thing sold. And that's what made the investment real to us after we had that execution.
And on our end, like, we want to get paid off as quick as possible, right? Because the sooner we got our money out of it, hey, listen, if it's spitting out good distributions, I don't mind. I mean, at the right percentage of the distribution, the thing can be out forever, even if there's tons of locked equity, if it's congruent. The problem is most of the case it's not. So, and I'll circle back to that here in a second. But we wanted to get that thing back as quick as possible so we could get all of the, so we get the capital back and juice our returns. And listen, it's not just about an interest rate return or a percentage return on money. It's actual dollars and cents. That's what's the important part is. But, when you're doing some sort of deal and you're not getting paid through until there's an equity event, either a refinance with refinancing the proceeds or a cash or a sale, you're working for free. And I mean, that operator was working for free as well. He wasn't making any money, right? And that's the tough part. Like, a real quick tip: if you're doing a syndication with somebody, or if you're investing in a syndication, or you're investing in a business, or you're doing something, and that operator is not making money until the back end, which is okay. There's nothing wrong with that. You need to make sure everybody's aligned, because if they're not planning to get paid back for years and years and years and are doing tons and tons of work, like, they might lose interest in the project. And that's a scary thing. You want them to be incentivized. I'm not saying like pay them a salary or anything else, just things to take into consideration when you're underwriting. And, I like that case as long as they're motivated to personally,
Right.
because then all of our money's, we all get money out together and it's equal. But at the same time, like, nobody wants to work for free for 10 years before something happens. So,
right.
You got to make sure. Okay. So anyways, I think the original goal on this was to get this thing stabilized, get this thing increased in value, and get this thing sold and get a quick hit, give or take. And the longer the thing was in play, the capital investor made the most money, right? Because it was out, it was a $200,000 loan and they were making a 10% return. It was out for 3 years. They made $60,000 in real time.
Yep.
Right. Not in real time. Yeah. In real time, monthly. There was monthly payments going to them in real time. And then Ian and I made 30 grand with, for the most part, $0 invested, right? Because we didn't really have our own money invested. But let's use the math as a whole, right? $200,000 was deployed. It wasn't our money because we used a passive investor in it. But like, let's just assume it was our money, like our team, right? Like our team put up $200,000. Got $60,000 back in 3 years, if you're following, right? $20,000 a year because it was 10%. $60,000 plus another $60,000 because, my company owned 15%, Ian's company owned 15%, right? So that's so we each got $30,000, 30% total, but it ended up that we each got $30,000. So $60,000 to the capital investors, $60,000 to us collectively. So that's $120,000 based off $200,000 or $210,000, something like that, original capital amount. So like do the math on that. Do the math. As a team, we made $40,000 a year technically as a team. Like if you go back on a $200,000 investment, so that's a 20% return. Did I do that math right?
Yep. Yeah. Essentially.
So we made a 20% return. Everybody's going to take a 20% return. That's a good return. That being said, imagine if that was executed earlier on. It would have been. It could have been juice. It could have been juiced.
Well, I think there's also like this breaking metric to say like, oh yeah, well we were shooting for this number. I think a better way to look at it is to say, well, instead of getting 120 grand, we would have gotten the same back end sale number, but the capital investor would have gotten less because the loan was outstanding. So our rate of return, just 1 year on 210 is what, 21,000 plus 60 is 81 over 210 is what? Basically a 30% return, right? Even though we got less cash per se to the capital investor. And I think that's where people's minds start to lose because like, oh, that guy only got 10 grand on his 210 or 20 grand on his 210, but that guy, that's all that guy wants, right? Like he wants that stable 10%. We all want that big equity pop to follow suit. So you went from 30, I would have to guess from 30% probably down to 25%, down to 20% per year. Now, there's also a case to be had to say, if this thing was spitting out $40,000 a year of cash flow to all of us between the note to the capital investor and another $20,000 to us, we would have said, well, don't sell it, Shane. Like now we need to get, 400,000 or whatever on the back, right? Because now we're getting real returns in real time above and beyond what we expected. So I think that's where like that rub is like, yo, how much cash you getting out? Like the equity pops are cool. And a lot of people are starting to see that, right? Because a lot of people bought really good stuff from, say 17 to like 21. And then there was this massive skyrocketed in pricing. Rents came up with it. But now people are starting to see the retractions, right? And they're starting to realize that they got all this trapped equity. And it's like, yo, dude, I got $2, $3, $4, $10 million. Maybe it's $100,000. Maybe it's $10,000 to you. You're like, yo, I got $10,000 stuck in that property. I got to sell it. I got to keep it moving, right? And I think more people are realizing that. More people are awake to it. Our scenario is a property that we can list for 2.7. We owe $2 million on. After broker fees and assuming we don't get top list, we're going to pull out, $300,000 to $500,000 for us and our capital investors. That's a no-brainer. We're not making distributions today because we took such a big refinance proceeds up front that this is a no-brainer. Let's get it sold. let's keep moving. Let's trim the portfolio. Let's get real skinny again. And we'll find places to redeploy it, whether it's 1031, whether it's going out and buying something new and cost segging it immediately, or just paying the damn taxes, right? Somewhere along the line, someone in your family lineage is probably going to pay the taxes. So maybe you're better off just getting it over and done with now and finding something new to invest it in. So that's what I'm excited about for 2025. And this topic is near and dear to our hearts at the top. And I expect to execute on this all the way throughout the year.
Yeah, we can wrap up with this. Money now is always better than money later, right? And there's a cost to that. So, hey, listen, if I'd give you, $5 today, would you rather $5 today or $10 tomorrow? Okay, well, if tomorrow's one day, cool, I'll take the $10. If tomorrow's next week, great, maybe I'll still take the $10. But like, what was if
3
tomorrow's
years?
Yeah, imagine if it's a year from now.
Yeah.
Would you take $5 today or $10 in a year from now? You take the $5 today. Now let's up that a little bit. Would you take $50,000 today or $100,000 in a year from now? Yeah, I'd probably wait and try to do $100,000. These are all games that you got to play in your head related to that. Money today, when it hits your pockets, guaranteed, it's yours, right? Yep. Money tomorrow is not 100% sure thing. There's other risks. There's other things that can stand in. There's other things that can stand in the way. So you got to make sure the risk first rewards make sense. And that's always a game I kind of play in my head on any investment that we're involved in. Yep. It's like, hey, I could take all the chips off the table right now. Does that make sense? Or just let this thing ride, let this thing grow. If you're in an appreciating real estate market, that might make sense to do. A buddy of both of ours posted something recently, lives in Florida, that he's in the process of selling all his single families in Florida because he's nervous about the insurance situation. The market's really appreciated and he's got a lot of equity in it and he wants to move on, and he'll take that, again, he's not taking that money to retire. That's a big point. Or taking that money is not even to retire, to do nothing with, to just go spend.
Yeah. He
wants to outperform. Maybe that's a good term for this episode. Outperforming your current assets. How can I take my current assets and outperform them with the cash on my next investment? And I think that's the play. And if you can do better with another investment than your current investment, it makes sense to take that and turn it into more.
And I think that's a big as a point that I was going to drive home before we wrap this up, and we're going to get out of here in a second, is this. Don't be lazy. Too many people buy the real estate, they get involved with it, and they're like, oh, I'm on easy street, and they set it and forget it, and then they stop buying stuff. And they're like, oh, I'm not going to sell it because this thing performs for me. Screw it. It's easy, right? Yeah, it's hard to go find new assets. It's hard to go make them perform. But if this is what you love and this is what you do every day, you should always be recycling your portfolio and looking at how to make it better. And if you want to be lazy, then go buy stocks, right? That's why a lot of people buy stocks, because they can set it and forget it and pray that the U.S. economy is here later. But if you're in real estate and you have this trapped equity, it's a no-brainer, dude. Free it up. It's a massive learning lesson that we finally had 10 years into this whole thing. I finally understand why people sell assets, why they recycle capital, why they execute on it as fast as they do. And it makes you wonder sometimes, but then again, we wouldn't be here if we didn't take this road. So game on, let's execute and go from there.
So a lot of times they just reach capacity. Assets do reach capacity. There's only so much money you can make out of a single family house. And that's okay. If that's the game that you're in, that's okay. And listen, if your goal is to have 100 free and clear properties and whatever it is, and they're all free and clear and they cash flow, I would bet you that the rate of return you're making on them is not nearly as high as you can make on a safer, easier asset. But that's okay. If that's the goal and that's what and that's what you want to do, continue to do that. And if you're at the growth phase, level up and get to the next asset class. You don't need to, but this is in essence how to continue that ladder of not just, wealth building, but personal development and asset classes and everything to take it to the next level. That would be the way to do it.
We next time we get a break in the podcast guest, we should do a legacy business versus legacy real estate comparison. Because I think you could speak intelligently on like legacy business and the fact that it's can grow way bigger than real estate.
Yeah, I think business will win.
Yeah,
I think good. I mean, typically good business will always outperform good real estate.
1000%. So either way, boys and girls, that's our learning lessons over the past year. It's a conversation that we have probably once a week, if not more, mostly because Jason's in a bunch of our deals and he's like, dude, you need to sell them. I'm like, I know. But he's transactional. I'm not. But you know what? We land somewhere in the middle, right? And that's the big thing. So we'll continue to case study our portfolio in real time throughout 2025. And look forward to see what everybody else is doing. You know, leave a comment down below. Let us know how you view this subject, and we will catch you guys on the next one.
Thanks for tuning in to the Real Estate Reserve podcast. Do us a favor and like, comment, and share our broadcast. It helps the algorithm and helps us spread the word too. Till next time, thank you for tuning in.